Joining us now is Scott Sperling, co-CEO of THL Partners. And good to see you, as always. I kind of get the feeling this is going to be like Druckenmiller 2.0. Did you see Stan the other day?
I did. I actually
Were you nodding a lot?
I think the concerns that he expressed are reasonable concerns that we all need to be thinking about. And the scarier part of it is obviously the long-term set of issues that we're dealing with. And I think how that affects particularly your thoughts about sustainable interest rate levels has a big impact on all of us as investors.
You bring up some of the same things, and I'm just, you can explain it after I just mentioned a couple of things. Sticky inflation, big bond issuances, which can affect interest rates. It's supply and demand too. So there's a lot of reasons why rates probably shouldn't come down now.
Shouldn't come down.
What's the Fed talking about?
Now, first, let's put it in perspective. The rates today are not ridiculously high. The rates today, in terms of a long-term picture, are not unreasonable, and people can do business, and there's lots of financing for private equity available, and it all makes sense. It has to do with how does that impact your entry price, and what's the right assumption about exit multiple when you're buying a business. So for us, it's buying the whole business and looking at it. For the stock market, it's what do you think the multiple should be on a sustainable basis longer term for a given stream of cash flows. So we may be optimistic about certain earning streams, but it will be impacted by the value will obviously be impacted by what you think the longer term rate situation is. I think one of the big fears is as you look at that supply and demand, you look at the fact that we will be approaching 130, then 150, and then 190% of GDP on the current path that we're on over the course of the next 2 decades. That's a lot of treasuries that need to be financed. And where's that money coming from? Right now, Japan, which had been one of the biggest buyers of treasuries, the way the exchange rates are working, it makes it more difficult for them to be an active participant. The issues with China we're all well aware of, and there's no solution that we're looking at longer term. And then if you look at the Fed, can the Fed continue to effectively ease through being an aggressive purchaser? That's an open question. So, that's one of a series of things to be concerned about in the context near term of the economy is probably better than many of us thought it might be at this point in time.
But not as good as what people think. Maybe.
But probably when it's again the skin deep thing. When you dig down a little bit below, you have to be concerned with some of the credit ratios that you're seeing out there, the amount of pressure on consumers, the aggregate or cumulative effect of very significant inflation over time. Mm-hmm. And then from a business perspective, we're in a very difficult regulatory environment that some things may be good, some things may not be good in other contexts, but it all adds cost. We're in the midst of energy transition, and that may be a good thing longer term, but let's not underestimate the very significant cost it has. And then on the labor side, there are shortages of very key skilled employees. So it may be that you're looking at a overall unemployment rate that may go up a bit, and you think that's easing. But in so many key industries, take healthcare, the lack of technicians, the people who provide a lot of the more skilled services. I mean, that's a big issue, and that leads to significant inflation in an industry that does not have offsetting revenue increases to manage that. So there are a lot of pressures.
One thing that makes me want to have a good weekend.
Okay, well, the good weekend, if you want to take the other view of it, is the market has migrated over the course of a decade to better business models, more recurring revenue models, arguably in many cases lower capital intensity. Although if you look at one of the better opportunities in semiconductors, that's obviously a very incredibly capital intense business, but the nature of the demand there is something that will continue to grow. So there are areas, there are pockets, I think, that
but overall, Scott, you think corporate cost structures are going to be higher, and maybe the economy is going to be not as good as people think?
We have to continue to be aggressive in how we manage those cost structures in light of things that you can't fully control. So I think wage inflation will continue to be well above the 2% overall inflation target range. The election could have an impact in terms of the NLRB makeup, but we've been in a very aggressive environment for that. But again, there are other forces at work there.
Any cuts this year? When do we get to 2% inflation? When do we get to 2%?
I'm not a big
That's
believer.
What scares me.
I don't think we're getting to a sustainable 2%. We may.
Till when?
We may go down.
Ever? They got to move the goalposts.
It's hard. Again, when you think about other societal needs or wants, again, energy transition, the ability to provide people with so-called living wage, better wages. Yep. Those are really strong forces that work to counter other elements of productivity that might drive us towards overall 2%.
And even AI, that might be increased productivity. That's going to be expensive and energy intensive and everything else.
I mean, if you look at the investment in servers, data centers, energy, nobody, as we move towards more electric everything,
right?
Nobody has yet explained how we're going to get that capacity, and how we're going to pay for that capacity. And I think if ideologically we also have it has to be this, and it can't be everything. So there are people who don't like nuclear, or people who basically say natural gas is not really
cut off the LNG
clean fuel.
And we might have to continue to spend some money on defense. I have a feeling.
Well, it is clear we're in a world that is dramatically different than we imagined 20 years ago, when we decided that we should cut defense spending and break down a lot of the production capacity of our defense industry.
All right, it's still it's going to be a crappy,
Aren't you happy?
It's going to be a crappy weekend. Crappy weekend, Scott. Thanks to you. No, it's all good points and very similar to what we heard earlier this week.